Thank you, Mr. Lang. And almost every member of this committee will be here today on both sides of the aisle. Make your answers as brief and as quick as you possibly can. So thank you for that. In 2019, by votes of 4-1 and 5-1, now chair of the NEC, Leo Brainerd, the only dissenter in every one of those votes, the Fed rolled back stronger rules and was responsible for supervising Silicon Bank. Mr. Vice Chair Barr, did the Fed drop the ball because it didn't see the risk that was building?
Thank you, Chairman Brown, for that question. Fundamentally, the bank failed because its management failed to appropriately address clear interest rate risk and clear liquidity risk. That interest rate risk and liquidity risk was highlighted by the supervisors of the firm beginning in November of 2021. The board the Federal Reserve Bank brought forward these problems to the bank, and they failed to address them in a timely way. That exposure led the firm to be highly vulnerable to a shock, and that shock came on the evening of Wednesday, March 8th, when it very belatedly attempted to adjust its liquidity position and reported losses on its available-for-sale securities. The market reaction to that was quite negative, and that eventually on Thursday sparked a depositor run.
So some of their practices appear to have violated the basic principles of Banking 101, concentration risk, over-reliance on uninsured deposits, inadequate liquidity, poor risk management, the list goes on. How poorly managed was this bank?
Supervisors had rated the bank at a very low rating. Normally, we would not be describing these matters, confidential matters, but given that the firm failed and triggered a systemic risk determination, I'm prepared to talk about that confidential information. That the firm was rated a 3 in the Camel scale, which is not well managed. And at the holding company level, it was rated deficient, which is also clearly not well managed.
Okay, thank you. Chair Gruenberg, I heard from many small businesses over that weekend who had money in SVB and were worried about making payroll in Ohio, making payroll as a result of the failure. I heard from Ohio small banks and credit unions worried about deposits leaving their institutions. I know that I'm not unique. Many of my colleagues from both sides of the aisle heard those same concerns in their state. Given the unprecedented scale of the bank run, what would have been the impact on small banks and small businesses across the nation if you and other regulators had not taken action to protect depositors at SVB and Signature Bank?
Senator, that was our central concern. I think the evidence suggested from the sequential failures of first Silicon Valley and then Signature that there was a significant risk of contagion to other institutions. And in fact, over that weekend, we were seeing serious stress at other institutions. And I think that and the potential knock-on effects of that contagion is really what led the Federal Reserve Board and the FDIC Board unanimously to recommend to the Treasury Secretary.
So you're saying the actions taken were the least bad option for small businesses and banks across the nation. If you hadn't acted that way, you think there would have been a contagion?
I think there would have been a contagion, and I think would be in a worse situation today with consequences for the actors in our economic system that you referenced.
Regulators, Republicans, Democrats, all across the board, there was agreement on those actions.
Yes.
Undersecretary Lang, do you agree with that?
Senator Brown, I do agree with that. I think the actions that were taken have been working to stabilize deposits. Had they not been taken, the runs by uninsured depositors from many small and regional-sized banks and mid-sized banks would have intensified and caused serious problems for small banks' liquidity and their ability to support small businesses.
Thank you. And if you could answer this really briefly, because I don't want to go over my 5 minutes. Chair Gruenberg, the FDIC announced the sale of SVB and to First Citizens Bank and Trust from Senator Tillis' North Carolina. Estimated would cost the Deposit Insurance Fund approximately $20 billion. How's that cost covered?
Oh, that is required by law, and I indicated in my opening statement The FDIC has to impose an assessment on the banking industry to cover the cost of a coverage for any uninsured deposits. And I would note that the law provides the FDIC authority in implementing that assessment to consider the types of entities that benefit from any action or assistance provided. And as I also indicated in my statement, we expect to issue a notice of proposed rulemaking for public comment in May to implement the assessment.
Thank you. And I would point out in your testimony and your answer, there are no tax dollars, nothing funded through the Congressional Appropriations